Hi, I'm Barbara Friedberg, former portfolio manager and university investments instructor, and basically an investing expert. Today, I'm going to talk to you about a crowdfunding real estate debt investing platform. I'm going to give you the pros and the cons and help you decide whether this is the type of investment you want to add to your already diversified portfolio. So let's get started. First of all, what is Groundfloor? It's an app and a website where investors can be the bank. You can purchase loans that have been lent out to borrowers who want to fix and flip a house, to refinance, or whatever. You'll get interest payments back just like the bank, and when the loan is paid off, you get your principal back. We're going to find out if this type of investment is good for you. Groundfloor has been around since 2011. They've been lending money to borrowers so that they can fix up a home or an apartment and resell it, so that they can refinance, so that they can make some changes and then recoup their investment. Now, if you want to be the bank and get in on the lending, collect the interest, and then collect the principal payment after the loan is repaid, then Groundfloor might be for you. On average, since 2013, Groundfloor investors have earned approximately 10% per year. So, let's talk about how it works, who this investment is for, and where you can learn more. Groundfloor makes acting like a lender and earning those returns accessible to everyone, not only high net worth people. So you can start investing with $100. Their loans are qualified by the Securities and Exchange Commission to offer real estate debt investments. And here are some of the topics we'll cover today. But trust me, not all of them, or this would be way too long. We'll get into pros and cons, who can invest, how does it work, and how liquid the platform is. Because I'm going to put this out here right now so you can turn off if this is not going to work for you. Groundfloor investing ties up your money for a short term, from 1 month on up to maybe a year or two. So if you're looking for an investment where you can earn higher returns, but you want it to be completely liquid, that means you can sell it like in the public markets immediately, then turn this video off. It's not for you. But if you can leave your money invested for a little bit longer, then you have the possibility of earning a steady cash flow paid out every week, and also getting your principal back at the end of 6 months, 9 months, a year, 18 months. What are you investing in at Groundfloor? Most of the loans are issued to experienced developers. As I mentioned before, they're flipping homes, they're building new construction, or they're refinancing for long-term holds or rentals. Here's what your portfolio will look like in their flagship Flywheel portfolio. It's kind of like a fund that's made up of a whole bunch of different investments. So you won't be in a pickle if 1 or 2 of those investments default, because there are going to be hundreds of others that will still be earning to offset those minimal losses. Let's get into the pros and cons. You can earn weekly cash flow with the Flywheel portfolio. That cash flow will be made up of loans that are getting paid off or interest payments are coming in. The average 10% annualized return since 2013 are 10%, but that doesn't mean you're going to earn 10%. There is a low $100 initial investment for the Flywheel portfolio, which we'll describe in full below. And this investment, unlike many of these other private real estate investments, is open to accredited, that means people that have a lot of money and they understand the investment markets, and non-accredited investors, which means you don't know a whole heck of a lot, but you're looking, or you may know a lot, but you don't qualify to be an accredited investor, but you're looking for a place to earn cash flow. you're getting a lot of diversification within this real estate asset class. They have pretty low default rates. Since 2013, the default rates are 0.84%, which is relatively low. And if you're an international investor, you can get started with a $5,000 minimum. Now, there aren't many investments available in the U.S. that are also open to international investors. Okay, I would be remiss if I didn't talk to you about the downside of investing with Groundfloor. It is less liquid than public investment markets. You can't log into your Fidelity or your Schwab or your Groundfloor account and click sell and sell everything whenever you want. You have to wait till the loan matures before you can redeem the cash. Of course, loan defaults will cut into your returns, and there is a management fee on the Flywheel portfolio, which ranges from 0.5%, a half of 1%, to 1%. But the cool thing is everything is very transparent. This is all laid out on their website, and that's one of the things I really appreciate about this platform. Now, in addition to their fund, the Flywheel portfolio, they do have something called Groundfloor notes, which were similar to certificates of deposit, except the notes are made up of loans. And we'll talk a little bit more about those as well. Groundfloor notes are similar to publicly issued, non-traded secured debt. They have a set repayment term. And that makes them a good option for those who are looking for a predictable source of income with significantly higher yields than treasury bills or CDs. But let me put in here, it's really important to understand these are not as risk-free as treasury bills, and they are higher risk because of the possibility of defaults of the loan holders. They'll be higher risk than, say, a certificate of deposit. But if you're comfortable with sacrificing a little bit of risk in order to get a higher return, then the notes might be worth it for you. Now, there are two types of Groundfloor notes. There are the standard and the rollover. And both of those types of loans can be redeemed within the first 30 days. So if you change your mind, you decide you don't want to keep your money locked up, you can take the money out within the first 30 days, no penalty, but you will sacrifice some income. So the standard notes come in 30-day, 90-day, and 12-month terms. Those are the amount of time that the money is lent out. That is the amount of time that your money will be tied up. And today, in mid-March 2025, the yields range from 5 to 7.5%. Now, the yields are going to vary based on the current market interest rates, clearly. So if interest rates go up, the notes will pay higher yields. If they go down, unfortunately, you will obtain lower rates of return. You can withdraw your money upon maturity. So let's say you have something that you want to, let's say you have a vacation you want to go on in 60 days and you want to get some higher yields on your cash than just leaving it in your savings account. You could invest in a 60-day Groundfloor note, and then at the end of 60 days, you take the money plus the interest and you're ready to go on vacation. Now, the other type of Groundfloor notes are the rollover notes. They're similar to the auto investor account, which means upon maturity, the notes automatically roll over and invest in a new rollover note of the same term. Groundfloor's mobile app and auto invest feature are available in the Apple app and Google Play stores. The apps are very, very similar to the website, and you can see how your investments are doing in your Flywheel portfolio, look at your dashboard, like right here. See your money at work. You can look at returns for 3 months, 6 months. You can look at your disbursements. That means the money that you take out. Now, what about the fees? Well, the company does make money from borrowers because the company charges those who borrow money and take out the loans from 2.75 to 4% of the principal amount, plus a $4.95 application fee. As we previously said, Flywheel investors will pay a 0.5 to 1% fee when they receive their principal and interest payments back. But that 10% average historical rate of return is after fees are paid. So how do you actually make money on Groundfloor? Well, if the project runs smoothly, then you'll receive a proportionate of the interest payments and a lump sum payment of the principal when the loan matures. Because you're invested in hundreds of these projects in the Flywheel portfolio, you will start seeing reimbursements trickle in every week. And then, of course, as we just said, the ground floor notes will mature in 30, 90, or 12 months, and that's when you'll see your return of principal and interest. We talked about defaults, and they do have a relatively low default rate. But when a borrower does not pay, the company comes in with a team. They try and work with them so that they can get some of the money back. And whatever money they do get back, plus any penalties, you will be able to recoup. Now, we've got a whole lot of frequently asked questions here. You can see those questions when you look at this article online. And of course, we'll put a link below to the article. So let's wrap it up now. Is ground floor investing for you? Are you someone with a diversified investment portfolio and you've got some stocks and some bonds, but you like a little bit higher yield on a fixed income investment? And you're willing to take on a little bit more risk? Well, then ground floor real estate investing might be for you. The platform offers high yield loans to short-term real estate borrowers. Investors can purchase a fractional portion of these loans through the Flywheel portfolio. And if you're looking to gain higher returns than you might get on a CD or a government note for money that you'll need within the next few months or year, you might consider the ground floor notes. Realize that although historical returns have been approximately 10%, there's no guarantee that those returns will continue in the future. Use the link below to get $50 added into your account when you sign up for Ground Floor. And if you like this video, please sign up. Give us a thumbs up, tell your friends about it, and we will see you next time. Thanks for watching.